Welcome back to the deep dive. Our mission today is, well, it's about the very architecture of our economy. Specifically, we want to know why sometimes the wealthiest people can lose everything in what looks like a sudden financial fire sale. We've gone through the analysis of a master global macro investor, someone with 50 years of experience navigating these cycles, to give you a shortcut to understanding how it all works.
And this isn't just, abstract theory. These patterns of huge wealth creation and then destruction, they're driven by the same engine every single time. We're going to focus on three connected ideas. First, the really critical and often misunderstood difference between wealth and actual money. Second, how that dynamic is what creates and then inevitably bursts these massive credit bubbles. And finally, how the kind of extreme wealth gaps we're seeing today, well, they magnify the risk, turning a financial bust into something that could be socially and politically explosive.
Okay, let's unpack this then. Starting with what feels like the biggest misconception, the difference between financial wealth and money. Most of us hear wealth and we think, cash, liquidity. But the source material is very clear that financial wealth is, well, it's easy to create, and it often doesn't represent its true value.
It's basically a collective agreement, a story we tell ourselves. Think about a tech startup founder. A VC fund comes in, they buy a small piece of the company, let's say, for $50 million. Based on that one sale, the valuation for the whole company can instantly jump to $1 billion, and boom, the founder is a billionaire.
Right. But $1 billion in actual spendable cash didn't just appear out of thin air.
Not at all. Of course not.
And the public stock market is just that on a much, much bigger scale. A few trades happen, they set a price, and that tiny action determines the perceived wealth of billions of shares that didn't even trade. It's a paper value, a mark-to-market number.
And that distinction right there is the single most important principle for understanding any crash. Financial wealth is totally useless until you convert it into money. Money you can actually spend or use to pay off a debt. And that act of conversion of selling the asset, that's the choke point. That's what triggers a bust.
Which brings us to the fuel, the element that creates these massive imbalances in the first place: credit. We have to be really clear here on the difference between money and credit. They are not the same thing.
Not even close. Money is what settles a transaction for good. Only the central bank and the banking system can really create it. It's the limited resource in this whole equation.
The credit.
Credit is different. Credit is cheap. It's easy to create. When you get credit, you're just creating a debt, a promise that you'll get real money later to pay it back. And because so much credit can be created so easily while the supply of money is tight, well, that's the fuel for any bubble.
That's the key. We're using easy credit to bypass the discipline of hard money. And that sets the stage for the big one, the mechanics of the boom-bust cycle.
It all starts with the bubble phase. What happens is buying financial assets is financed by just this explosive growth in credit. People are borrowing, leveraging up.
Using their house, their stocks, whatever, to buy more assets.
Exactly. And this borrowing creates that massive chasm we call the wealth money gap.
Oh.
You have this enormous, easy-to-create paper valuation of wealth towering over the very limited, fixed supply of actual money needed to settle everything.
And as long as the credit keeps flowing in, the party keeps going, that paper wealth feels completely real.
The reversal of the bust phase begins the moment that dynamic flips. The moment holders of all that paper wealth suddenly need to get their hands on liquid money. And most of the time, that need comes from having to pay back the very debt that they used to buy the assets in the first place.
And that's where the self-reinforcing downward spiral kicks in. This is what makes a crash and not just a little dip. If the demand for money to pay debts, to meet margin calls, if that demand suddenly swamps the actual supply of money available, people have to sell immediately. They can't wait.
What's fascinating here is bubbles don't burst because investors all suddenly agree that, prices are too high. They burst because of a liquidity failure. The flow of money and credit into the asset just dries up. And at the same time, existing owners are forced to sell to get cash for their immediate needs. So prices fall, debt defaults start, credit shrinks. It just feeds on itself.
The crash is basically guaranteed the moment the need for cash outpaces the supply of cash. The classic example everyone points to is the Great Depression, the whole 1927 to 1933 period.
Precisely. In the late 20s, credit was everywhere. People borrowed huge sums to buy stocks, creating enormous debts. The 1929 crash didn't happen in a vacuum. It happened when the money needed to service all that debt became greater than the money the assets were actually producing. Forced selling began, and that just accelerated the whole thing into a 4-year depression.
And the political fallout was just unbelievable at the time. The social conflict was intense. You had President Hoover replaced by Roosevelt, who came in and in 1933 just rewrote the entire economic rule book. Massive deficits, printing money. He actually devalued the dollar against gold, which helped debtors, and just sweeping, shocking fiscal changes.
And that history brings us right to today and why the current situation feels so precarious. That same bust dynamic is now being magnified by extreme wealth gaps. When a market decline starts, these huge gaps act like an accelerant. They just intensify the anger and the political friction between the haves and the have-nots.
So it's not just an economic event anymore. It becomes a major social and political risk.
Aye.
And the numbers from the source material, they really paint a stark picture.
They're stunning. In the U.S., you have the top 10% of households earning about half of all the income.
Okay.
But they hold roughly two-thirds of the total wealth. And this is the key part for our discussion. They own nearly 90% of all equities.
90%.
And their wealth grows mostly through asset appreciation, paper gains, which, importantly, are unrealized. So they aren't taxed until the asset is sold.
And then you contrast that with, what, the bottom 60% of the population?
A completely different world. They earn about 30% of the income, but own a tiny 5% of the wealth, and an even smaller slice of equities. Their economic situation has been stagnant for a long time. So when a crisis hits, you can see how that creates enormous political pressure for redistribution.
And it seems like there's a concentration within the concentration, right? The current boom is so heavily focused on just a handful of top AI stocks, the Mag 7. And AI itself seems to be accelerating this wealth gap by replacing jobs while making owners more productive.
That is precisely the implication from this analysis. The very technology driving the boom may be worsening the two critical imbalances at the same time, the wealth-money gap and the people-to-people wealth gap, which leads democratic governments today into what is essentially a trap. They're stuck. They're already over-indebted, and they can't use the three traditional tools to fix things: borrowing, taxing, or cutting.
Let's walk through that trap because it's so important. First, why can't they just borrow more money?
Well, free market demand for their bonds is already weak, unless they offer really high interest rates, which just makes the debt worse. On top of that, international buyers, other countries, they're getting nervous. They're shifting away from government debt and into things like gold. So that option is closing.
Okay, so borrowing is off the table. Why can't they just raise income taxes on the wealthy to fill the gap?
Because the wealthiest are mobile. You raise taxes too high, you risk capital flight, they just move somewhere else, and you lose their tax base entirely. Plus, if you hit them too hard, you risk popping the very financial bubble the entire economy is resting on.
And the third option, cutting spending. That's the political third rail. You can't touch it.
You can't. Not really. Those cuts would disproportionately hammer the bottom 60%, who are already struggling. It's politically toxic and, many would argue, morally unacceptable in a democracy. So governments are completely trapped.
So if they can't borrow, they can't tax income, and they can't cut spending. The conversation naturally goes to the one place where all the money is sitting: wealth taxes, targeting all those unrealized gains we talked about.
And if we connect this all back to the bigger picture, the idea of a wealth tax is a direct threat to that core wealth-money imbalance. Why? Because it forces the one thing that triggers a bust: a massive, unavoidable sale of assets to get liquid money.
The numbers on this are, frankly, terrifying. U.S. household wealth is, around $150 trillion? But the amount of that in actual liquid cash or deposits is less than $5 trillion?
That's the whole problem in a nutshell. It is a system with immense paper value, but very little cash to back it up. So now imagine you impose what sounds like a modest wealth tax, say 1 or 2% a year, on that $150 trillion.
You'd immediately trade a demand for $1 to $2 trillion in cash every single year.
Cash that just doesn't exist in liquid form. That's nearly half the entire liquid cash pool. The wealthy would be forced to sell assets, stocks, private equity, real estate at whatever price they could get.
Which would instantly crater the market. And beyond that immediate liquidity crunch, the source points out 3 other big problems with a wealth tax. First is that capital flight we mentioned.
Right, the rich just leave. Second is the sheer difficulty of even doing it. How do you value a private company or a piece of art accurately every single year? It's a bureaucratic nightmare.
And third, from a macro perspective, you're taking money out of productive investments that create jobs and innovation, and you're just handing it over to the government.
Yes. The bottom line is that a wealth tax, mechanically, would trigger forced selling of equities, depress valuations, increase the demand for credit for everyone else, and incentivize anyone who could to move their wealth offshore.
So, given this perfect storm, the huge paper wealth, the tiny cash pool, the massive social gap, what do you do? How does one protect themselves during a period like this?
The historical playbook is actually pretty simple. Two core defenses. First, you avoid significant credit exposure.
Yeah.
You can't be leveraged. If you have a lot of debt, you will be a forced seller at the absolute worst time. And second, you own some gold. Gold exists outside the credit system. It's a form of money that isn't somebody else's liability. When all the financial promises start to break, it holds its value.
This has been an incredibly deep look at the gears of the economy. I think the core takeaway for me is that this combination, the massive wealth money gap and the extreme people to people wealth gap, creates what the source calls a very risky set of circumstances. A situation where political action is almost certain to follow any major economic correction.
Historically, this dynamic never resolves itself quietly. It's the classic setup for major conflicts and huge transitions of wealth, almost always driven by big political and social change.
Which brings us to our final provocative thought for you. Let's look back at that 1933 crisis. The system was trapped, just like today. And Roosevelt's response included raising the top marginal income tax rate from 25% all the way to 79%. So given the trap our leaders are now unable to borrow, tax income, or cut spending, what kind of dramatic systemic fiscal changes, things far beyond a simple market correction, might they feel forced to enact next? Something to think about.